Okay, let's dive right into this. Welcome to Iron Financial, everyone. Today we are putting CrowdStrike's Q2 earnings through an absolutely brutal, line-by-line structural stress test. I'm your lead analyst, and as always, my focus is purely on the hard, undeniable metrics. We're talking about the load-bearing annual recurring revenue, the raw cash flow engines, and the heavy operating leverage that builds truly durable, cash-printing machines. We are going to rip open the hood on a massive $400 million discrepancy between the reported and their adjusted earnings today. If you want to build a portfolio forged in iron and cut straight through the market noise, make sure you hit subscribe to this explainer series right now.
And I am the market skeptic. I represent all of you out there, the everyday retail investors who want to know what's actually holding the building up. Is this real fundamental strength or just Wall Street hype and accounting spin? Because we are definitely going to find out today.
So, the absolute core tension of today's explainer really just comes down to this one question. Look, CrowdStrike has delivered a highly publicized 9-quarter beat streak. On the surface, sure, that looks like a cast iron moat. But when Wall Street expectations are running this incredibly hot, we have to step back and ask, are we looking at an unbreakable cybersecurity platform here, or a massive valuation trap just waiting to collapse under the weight of its own premium? It's a totally fair question. Let's define what priced for perfection actually means in this context. When you are trading at a massive multiple of your sales, like CrowdStrike is, the market is literally pricing in flawless execution for years to come. Any microscopic crack in the structural integrity, whether it's a missed growth target or just a slight margin compression, it can cause a massive, brutal sell-off. And that's exactly why we don't just read the headline earnings beat and call it a day. We drill down into the absolute bedrock of the financial statements to see if that sky-high valuation is genuinely justified by the underlying cash mechanics.
Here is today's blueprint. We'll start with our hook, measure the top-line velocity and ARR, assess the structural margins, debate the gap leverage, inspect the balance sheet fortress, and then finally deliver our ultimate verdict.
Section 1. The Iron Financial Hook. Let's set the macro stage before we get into the heavy numbers.
Right, let me set the macro stage right now, because my hook is rooted in reality. We are looking at a cybersecurity giant operating in an environment where enterprise IT budgets are heavily scrutinized. To maintain structural momentum right now requires a product that customers view as absolutely essential, not just a nice-to-have. Behind these massive top-line numbers, and we're talking about billions in revenue, we need to rigorously inspect the cracks in the armor. It is very easy to paint a pretty picture with adjusted numbers. But when you factor in lingering post-incident headline risks, like the fallout from that massive July 19th IT outage, you really have to wonder if they are being forced to offer heavy discounts just to keep their customers around. Combine that with a heavy reliance on Wall Street accounting magic, and we can't just take management's word that the foundation is solid. We need to see the raw materials for ourselves.
Section 2. Top-line velocity and ARR. These are the absolute load-bearing metrics of the quarter.
So let's look at those raw materials. In the software as a service world, annual recurring revenue, or ARR, is the absolute bedrock of the building. It dictates predictability, cash flow, and your entire capacity for future growth. And right here is the headline load-bearing metric, $5.84 billion. That is CrowdStrike's ending ARR for Q2, growing at a highly durable 25% year-over-year. I really want you to stop and think about the law of large numbers for a second. Growing a $100 million business by 25%, okay, that's cute, but growing a nearly $6 billion base by 25%, that requires adding massive absolute dollar amounts every single quarter just to maintain the same percentage. It requires an industrial-grade sales engine and incredibly sticky customer retention. This isn't just standard growth, this is structural dominance in the endpoint security market.
And this next number brilliantly illustrates where that velocity is actually coming from. A record $332.8 million in net new ARR added just in this single quarter. That is a massive 51% surge year over year. Think about that for a moment. When you see net new ARR accelerating like that, it completely proves that the structural momentum is gaining serious velocity. But let's break down where this is actually coming from, because this isn't just a handful of new enterprise whales washing ashore. A massive portion of this is expansion within their existing customer base. Customers aren't just staying put, they're buying more modules, embedding CrowdStrike deeper and deeper into their own operations. This is the tensile strength of CrowdStrike's business model in action.
Now, the reason they are capturing so much net new AR and expanding so aggressively within their base is because of this exact architecture right here, the Falcon platform. Notice the concentric circles here. You have a single lightweight agent at the core, feeding into a unified data layer, which powers AI-native modules all the way to cloud security and identity protection. This single-agent, multi-modular architecture drives absolutely incredible unit economics through vendor consolidation. Instead of a customer buying 5 different tools from 5 different legacy vendors, dragging down their systems with bloated, conflicting software, they deploy one single CrowdStrike agent and literally just turn on new features as needed. That is a massive, structural, competitive moat.
Wait, let me stop you right there. I'm going to push back on this so-called unbreakable moat. Management is out here touting that Falcon Flex ARR doubled to over $2.29 billion. That sounds great on an earnings call. But is this genuine, organic AI security demand, or is it just budget lock-in? Are customers actually enthusiastically deploying all these modules because they love them, or are they just buying massive bundled enterprise agreements because CrowdStrike is forcing their hand at renewal time? Look, if it's just aggressive bundling, that's a potential single point of failure if customer sentiment turns sour or a cheaper, capable competitor arrives on the scene.
Section 3. Structural efficiency and margins. Time to look at the reality of cash. So, let's pivot the debate towards structural efficiency. It's great to have top-line velocity, but I demand to see how much of that velocity actually flows downward to the bottom line. As the old saying goes, revenue is vanity, margin is sanity, and cash is reality. Let's see if the margins are actually doing the heavy lifting here. Oh, I'll show you sanity. Look at this revenue breakdown. Out of $1.47 billion in total revenue, which was up 26% year over year, by the way, a massive $1.40 billion comes directly from highly durable, recurring subscriptions. Subscription revenue grew 27%. This means 95% of their total revenue is recurring. Let me explain why that matters for a second. If you are a hardware vendor or you rely on one-off software sales, you wake up and start every quarter at zero. You have to hunt for every single dollar. But with 95% recurring revenue, you have a cast-iron foundation of predictable cash that allows you to aggressively reinvest in research and development without jeopardizing the structural integrity of the overall business.
Okay, fine, but let's force a real comparison on those gross margins. Management loves to parade their 81% non-GAAP subscription gross margin. It sounds elite, but the GAAP reality, the actual, heavily regulated accounting reality, is 78%. That is a 300 basis point spread. I demand to know what lives in that 3% gap. When we are evaluating the true structural efficiency of a platform, shouldn't we base it on the unadjusted, hard numbers? Why do we give them a free pass on the costs they conveniently choose to ignore just because Wall Street says it's okay?
Section 4. GAAP versus non-GAAP leverage. Let's look at the operating leverage spread. That perfectly sets up our next section. We are now advancing to the most highly debated floor of the entire building, operating leverage and true profitability. This is exactly where the bull and bear cases typically collide head-on, and we are going to look at the exact spread between the GAAP and non-GAAP metrics to see if this leverage is genuine or engineered.
Yeah, and I am going to aggressively attack this massive delta. Notice the exact numbers we pulled from the Q2 statement here. CrowdStrike reported a $33.2 million GAAP loss from operations. Let me repeat that for everyone in the back, a loss. They actually lost money running the business. Yet, they report a $371.6 million non-GAAP operating income. That is a swing of over $400 million in a single quarter. This completely changes the narrative of the company. You absolutely cannot claim heavy operating leverage when the actual unadjusted business operations are losing tens of millions of dollars. That $371 million is just a non-GAAP fantasy.
And let's literally read straight from the SEC filings to expose what's hiding the cracks in the foundation here. How exactly did they bridge a $33 million loss to a $371 million gain? Well, heavy reliance on stock-based compensation. For the retail investors watching this, stock-based compensation means they are paying their employees in stock rather than cash. While it doesn't burn cash out of the bank today, it silently dilutes your shares, acting as a hidden tax on your returns by slicing the pie into smaller and smaller pieces over time. Then, add in the amortization of acquired intangibles, add in the costs and recoveries from the July 19 incident, plus legal reserves and massive settlements. They are taking highly material, real-world expenses that absolutely impact the business, and just waving a magic wand to exclude them from non-GAAP EPS. This isn't structural strength, it's just accounting scaffolding holding everything up.
All right, let me strike back here, because you are missing the most critical load-bearing pillar in all of finance. You cannot fake cash. Go ahead and debate the accounting adjustments and non-cash charges all day long, but analyze the actual cash engine right in front of us. They generated a record $530.3 million in net cash from operations and a record $377.4 million in free cash flow. That is hard, tangible capital actually entering the bank accounts.
Do the math on that. $377 million in free cash flow on $1.47 billion in total revenue is roughly a 25% free cash flow margin. When you combine a 25% free cash flow margin alongside a 25% ARR growth rate, you hit the legendary Rule of 50. That is elite blue-chip SaaS territory. When a company converts this much of its top line into pure, unadulterated free cash flow, it is absolute proof of an impenetrable operational inflection.
Section 5. The Balance Sheet Fortress. Time to measure their strategic optionality.
And that staggering cash generation perfectly transitions us to our final structural support beam today. A company's balance sheet dictates its absolute ability to weather macroeconomic storms, outlast competitors who are burning cash, and dictate the terms of its market. So let's see how much iron CrowdStrike has in reserve. $5.01 billion in cash and cash equivalents. This completely cements the argument that CrowdStrike operates with a cast iron balance sheet. With this massive $5 billion war chest and virtually negligible interest expense drag, they have ultimate strategic optionality. Can they acquire smaller, disruptive AI security startups? Absolutely. They aren't reliant on tight credit markets or high-interest debt. They are self-funding their hypergrowth entirely through their own internally generated cash flows.
And because of that undeniable balance sheet strength, management confidently raised the full-year FY27 guidance. Total revenue is now projected to brush up against $6 billion, coming in between $5.87 and $5.93 billion. Non-GAAP EPS is guided up to $4.93 at the high end. This raised outlook is definitive proof of business durability, signaling massive confidence from management that the sales pipeline is strong. Market skeptic. Okay, I have to interrupt here because you are completely ignoring the risk. Raising the full-year net new ARR growth expectations to 34% at the midpoint, that sets the bar dangerously high. In a market where multiple expansion has already priced in absolute perfection, pushing expectations even higher means they literally have no margin for error. Think about multiple compression for a second. If they guide for 34% and only deliver, say, 30% in Q3 or Q4, the market will ruthlessly reprice this stock downward. That multiple compression wipes out portfolios overnight. They're building a skyscraper on a very narrow foundation of flawless future execution, and honestly, I just don't buy it.
Section 6. Verdict. Opportunity or trap? Let's make the final call.
Which brings us to the moment of truth in this explainer. We have rigorously stress-tested the ARR, we debated the $400 million GAAP versus non-GAAP leverage spread, and we verified the $5 billion cash reserve. It is time for both of us to deliver our actionable ratings on whether the structural integrity truly justifies CrowdStrike's premium valuation. I'll go first. My rating is a definitive opportunity. The bull case is clear. This is an impenetrable cash flow moat. When you combine 25% ARR growth at a nearly $6 billion scale with an elite 25% free cash flow margin, the heavy operating leverage is simply undeniable. The platform consolidation is working, and the cash generation is incredibly real.
And I am issuing a blaring trap warning. The bear case simply cannot be ignored by anyone doing honest math. You have a GAAP operating loss of $33 million being entirely masked by massive stock-based compensation that dilutes retail investors, plus one-off litigation adjustments hiding the real costs. Add in the lingering post-incident headline risks and a sky-high valuation that demands 34% net new ARR growth just to tread water, and you have a valuation trap highly vulnerable to a single point of failure.
So the crucial point is this. We've laid out the structural blueprints and shown you the raw materials. Now it is entirely up to you. Ask yourself, is your portfolio forged in iron, built on undeniable free cash flow and structural market dominance, or are you buying into a single point of failure by willingly ignoring the GAAP realities and post-incident headline risks? Dive into the hard numbers, stress test your own assumptions, and make your decision without emotion. That wraps up this Iron Financial Explainer. Stay focused, stay disciplined, and we'll see you in the next structural analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.